The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, where we will be discussing the CARES Act. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks very much, Jennifer, and hello, everyone. Welcome to the era of social distancing, or I say welcome. I mean, we've all been in it for a couple of months now. Feels like longer, maybe. But I'm glad to join you today on this webinar. The CARES Act has certainly been right in the middle of the attention of the financial professionals that we work with. They've had lots of questions. Today we're gonna cover the basics of the CARES Act. We're not going to get into a lot of depth. As you can imagine, in a 15 or 20-minute webinar, we can't get into a lot of depth. But before we get started on this, let's figure out what we're going to talk about next month on June 3rd. Your choices are ethical issues with incapacitated clients, dealing with terminal illness, or CARES Act ambiguities. I'm going to ask Jennifer to open the poll right now. And ask each of you to go ahead and vote for the content that you would like to hear about next month. Please go ahead and take about 20 seconds to do that. If you haven't voted yet and you want to, go ahead and do that right now. We'll give you another 10 seconds or so. Great, thank you all for doing that. Next month we will talk about CARES Act ambiguities. So we will continue the theme of the CARES Act. We'll build on this month's webinar. By the way, that's Wednesday, June 3rd at 11 a.m. Central. Please go ahead and mark your calendars. All right, so let's go ahead and get started. What we're going to do, first of all, is we're going to start with an overview of the CARES Act. Secondly, we'll talk about how the CARES Act affects our individual clients. Third, we'll talk about the rules that will affect our business owner clients, and we'll touch briefly on the opportunities to serve our clients better. So, quickly, here's an overview of the CARES Act. Now, it's hard for me to believe, but the CARES Act is not quite 6 weeks old yet. March 27th, 2020 is when it was passed. And there's a variety of provisions in it, nearly all of which were aimed to jumpstart the U.S. economy during and after the business slowing side effects of the coronavirus. What does that mean? That means that now, as we start to come out of the social distancing, hopefully the monetary effects of the CARES Act will be helping us. People will have more money, businesses will have more money, and there will be other incentives for people to spend now that business is starting to approach coming back to normal. So let's talk about the effect on individuals first. The most obvious effect is the special 2020 federal income tax credit. So this is a credit that is available for this year and is refundable in advance by the federal government. It is available to low to middle income people. The federal government defines those folks as single people with adjusted gross income up to 75 grand, married couples with adjusted gross income up to 150 grand. Single people get, if they're fully eligible, get $1,200. Married couples, if they're fully eligible, get $2,400. And if folks are over those AGI thresholds, they get phased out, whereas they're completely phased out. Single people at about 100 grand and joint filers at about 200 grand without children are not eligible. If folks do have kids, they get up to $500 for each qualifying child. So your clients who are eligible for these tax credit refunds should be in the process of getting their checks. The IRS is using information from the 2019 and 2018 income tax returns to decide whether they think folks are going to be eligible. For folks that don't file income tax returns, Social Security 1099 is going to be used by the IRS to determine eligibility. And if the IRS has bank information for the taxpayer, they're going to do the payments by direct deposit. Otherwise, they're going to mail checks. So if you believe your client is eligible, but your client hasn't got the money yet, the link at the bottom of the page here can help your client determine what's up and check on the status of the payment from the IRS. That is a service that you can help your clients do while we are socially distancing. It's certainly something that you don't have to be in front of the client to help them do. So let's talk about another potential advantage for individuals. We've got a couple of charitable giving tax incentives. For those folks who are still prospering in spite of COVID-19, the CARES Act increases the limit on itemized charitable contributions made in cash from 60% of adjusted gross income up to 100% of adjusted gross income for 2020. So people who don't have a lot of income in 2020 can still make big charitable gifts and take the itemized deduction up to 100%. That isn't allowed for cash. It isn't allowed for contributions to donor advised funds or supporting organizations, but to other charitable organizations, it is okay. There's also a special incentive created for people who don't itemize. It's a $300, up to $300 deduction for charitable contributions for taxpayers who take the standard deduction. So a couple of a couple of potential major or little advantages for our clients there. The thing that we get asked a bunch about, the individual provision that we get asked a bunch about, is the tax advantaged access to qualified funds. And a lot of times the phone calls start with, well, there's this special thing that says that you can get 100 grand out of your qualified account without having to worry about the penalty tax. Well, that's not exactly right. There are special provisions available to a taxpayer who has been affected by COVID-19 where they have penalty-free access to IRA money, for example. But they've got to prove or be prepared to prove that they've been affected by COVID-19. Now, for somebody who caught the disease or someone whose spouse or dependent got the disease, they qualify. They can get up to 100 grand penalty tax free out of their IRA, for example. But the other standards are not quite as clear. If someone has experienced adverse financial consequences as a result of being quarantined, being furloughed, being laid off, having hours reduced, being unable to work due to a lack of child care, being a business owner that has been forced to close or reduced hours, then in theory, the person has the ability to access some of the benefits that we're going to talk about. So they've been affected by COVID-19. Some of those things are not easily black and white. They aren't easily applied to certain circumstances. It isn't a definite standard. The Treasury Secretary is supposed to come out with regulations that better define what adversely affected by COVID-19 means. The IRS has published at the link on this webpage some information about what affected by COVID-19 means. It's not overly helpful, but it does provide a little bit more detail than what the statute itself provides. And it does say that the IRS expects to come out with regulations relatively soon, whatever that means. So anyway, we're going to talk about the advantages for individuals. Understand that the advantages we're about to talk about presupposes that the taxpayer has met the standard described on this slide. So the first advantage is that the penalty tax on early distributions is waived if the taxpayer meets the standard for distributions of up to $100,000 taken this year. The second advantage is that if the individual gets a distribution from an employer plan, the mandatory 20% withholding that normally applies to the distribution, it's waived. The third thing is that if the taxpayer takes a COVID-19 related distribution, the taxpayer has the ability to defer income taxes associated with the distribution and spread them over a 3-year period. We're not exactly sure how that works, although the IRS has provided a little bit of information. Seems like the tax liability is pro rata over the 3-year period. And then the fourth thing is that the individual who takes a qualifying distribution has the ability to recontribute that distribution into the qualified plan or to an IRA within 3 years. So that essentially extends an indirect rollover period for qualifying COVID-19 distributions. What isn't 100% sorted out yet is that if an individual takes a distribution now, starts to pay the income tax associated with the distribution, but then completes an indirect rollover before the end of the 3-year period, how are they going to get their money back that they've prepaid to the IRS? The IRS has seemed to imply in some of the things that it published is that they're going to have to file an amended return for the year in question in order to get their money back. But we'll see how that gets sorted out, see if there's potentially an easier process than that for folks who try to do the rollover. So that first advantage, right, for people who've been affected by COVID-19 has to do with the penalty tax. This is about, do people have access to qualified plan funds at all? There's a lot of excitement on the part of clients and their financial advisors that that clients might be able to have access to 401k, 403b, other qualified plan funds while in service of up to 100 grand. And that is still potentially true. If someone's been affected by COVID-19 and if the plan administrator, the employer, permits the employee to have access to money under this special COVID-19 provision, they can have access of to up to 100 grand. And if the employer is so inclined, they don't necessarily need to amend the plan document right now to give that kind of access. And the law also says that if for those employers who do provide access, all they have to do is get a certification by the employee that the employee has been adversely affected by COVID-19. The employee has to swear that they've met the standard in order to free up the money. And so access to the money is available to those plan participants who are in service who have been affected by COVID-19 if the employer so allows. So a lot of qualifiers there. Have to think about it, have to do some checking, but potentially in-service money is available. And yes, the money can be rolled back into the plan or into an IRA within the 3-year period. The law also allows for enhanced qualified plan loan provisions. It used to be that a loan from an employer plan for those plans that allowed for loans was limited to $50,000 or 50% of the vested account balance. That's been raised to 100 grand or 100% of the vested account balance. And for those folks who had existing loan balances as of March 27th of this year, the CARES Act allows them to suspend their loan repayment obligations. They don't have to, but the participant can suspend the loan repayment obligation for 1 year. Interest still accrues, so the loan, still gets bigger if the participant takes advantage of this. But being able to suspend the loan makes the hope is that the economic situation for the participant is made better by not having to repay the loan for up to a year. Another individual provision that's gotten a lot of attention, the CARES Act, has waived the RMD obligation for minimum distributions that come due in 2020. Waiver applies to RMDs that were due for 2019 that weren't taken in 2019, where somebody planned to defer the first RMD until April 1st. So that 2019 RMD does not have to be taken. The calendar year 2020 RMDs for those who have reached age 72 in 2020, those are waived. Calendar year 2020 RMDs for those who had already begun RMDs prior to 2020, and beneficiary RMDs from inherited IRAs and inherited qualified accounts have also been waived for 2020. So there's an opportunity to talk to folks about that. For folks that perhaps have already taken RMDs in 2020 before the law was passed, you may have an opportunity to talk to them about indirect rollovers, at least with regard to the non-inherited IRA or qualified plan accounts. You may be able to take advantage of 60-day or extended 60-day rollover rules. The deadline for those for distributions beginning in February has essentially been extended to July 15th. Let's talk about business rules. Let's talk particularly about the Paycheck Protection Program. This has gotten a lot of press. The first time around, Congress and the President allocated about $350 billion in forgivable loans to small businesses to pay their employees during the COVID-19 crisis. All businesses with fewer than 500 employees were said to be eligible, and the loans would be forgiven as long as the money was used to cover payroll. You couldn't get a loan based on an unlimited amount of payroll. You could only consider $100,000 of payroll when you were applying for the loan. $100,000 per employee of payroll. A maximum loan amount 10 million or 2.5 times the average monthly payroll. So the loan was designed to cover 2.5 months of expenses, mostly payroll expenses. And loan payments were going to be deferred, and the interest rate on the loan that is not forgiven is 1%. Now, the money ran out quickly under the Paycheck Protection Program. Since the original passage, there has been a second round of funding. There has also been pressure on companies, including a fair number of public companies, to give the money back if they had access to other capital. Now, exactly what that meant or what that means is not really clear. There's been political pressure, and the new round of funding also created retroactive rules on eligibility and on loan forgiveness. Basically, Congress and the President have decided that that in order to be eligible for a loan, the business owner has to be worried about an economic downturn in the business and has to swear to that in a loan document. So exactly what that means, what the potential penalties are for businesses, what the standards are for businesses if they don't meet an ultimate standard that that the IRS might ultimately come out with, or the Small Business Administration might ultimately come out with. That's not clear. The bankers that we've talked to all seem to think that the money will run out soon. And so if you've got a business owning client who's eligible for PPP funds and has not yet applied, time may be running out. So you probably want to go talk to them, make sure that they do apply if they are eligible for a PPP loan. What other business provisions are available? Well, there's some FICA tax relief. The act allows the employer to delay the payment of the employer's share of Social Security if they want to. Deficit needs to be made up by the end of 2021 and 2022, half and half. But this tax relief program is not available to those employers who require a PPP loan. The act also creates an employee retention tax credit for those businesses that are that have fully or partly suspended operations as a result of government orders related to COVID-19. Tax credit is equal to 50% of qualified wages paid in 2020 after March 12th, and the maximum credit per employee is $5,000. What other provisions are in there for business owners? There's a direct incentive for a business owner to help an employee pay for student loans. They can provide that as an employee benefit and contribute up to $5,250 toward existing student loan debt in 2020. That's different from the normal employee tuition provision that is available as an employee benefit. It's a special thing, and it's designed to incentivize employers to help employees pay at least a bit toward their student loan debt. There's also been an enhancing of business deductions for business losses. Those were limited as part of Secure, and now they're enhanced again as part of CARES. For a better summary of that, take a look online, call us if you've got questions about it. But there are tax incentives that will ultimately be for the benefit of our business owning clients. So what is it that we should take away from this quick overview of the CARES Act? Now, first of all, our clients have questions about the effect of CARES on themselves and on their businesses. So we've got an opportunity to go talk to our clients. First of all, our individual clients, make sure that if they're entitled to the tax credit check, that they get it. Second, that our individual clients properly manage their RMDs for 2020. If they haven't taken any yet, let them know that they don't need to. If they have taken them, explore the possibility of doing an indirect rollover if they don't need the money. For our business owner clients, if they haven't applied for PPP funds, and if they are eligible, they need to apply ASAP because it's likely the money is going to run out. And then for all of our clients, make sure that they get all the benefits under the CARES Act to which they are entitled. And we have to figure out, if we haven't already done it, how to reach out to our clients virtually and talk to them about their financial opportunities. This is no exception. We can be reached here. I'm glad that you are all on this call. Thank you for participating in this era of social distancing. That's no reason to enforce virtual distancing. So thank you for being part of this. And at this point, let me turn the program back over to Jennifer.
Thanks, Linus, and thanks for joining us today. And remember to join us on June 3rd for our next webinar covering the Secure Act ambiguities. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.